That's awesome stuff, Kyle. A lot going on there in the market. I mean, it's cool to see that there's a discrepancy between the two overstock shares with the tokenized version, gaining, but it's still trading below at the end, right? So one would hope that someday it's trading above the NASDAQ price because that would mean that people are willing to pay a premium for that tokenized version. So I'm confident that one day we will see that slowly over time.
I definitely agree. But in the meantime, let's get right into the main topic, Herwig. You were talking about an idea the other day about how an issuer might leverage a smart contract to create programmatic rights of first refusal, commonly known as a ROFR. So let's use today's main topic to really flesh that one out a little bit. Do you care to break down the basics for our listeners?
Absolutely, with pleasure. It's been a topic I've been noodling around for many months now, and it's actually fairly simple, but also really important when it comes to the true digitization of investments. But first, let's of course break down ROFRs and what they're used, and also ROFR is a fun thing to say. And it's pretty self-explanatory as it is a right? So otherwise seen as an investor protection and benefit, and even can be a strategic advantage. And in this case, it is used as a right to refuse or invest, typically in future offerings, but it could be actually used for a number of things. The most common example of a ROFR is when you are investing in a business, typically as an angel or a venture capital investor, and you may want to protect your investment and even potentially buy more in future financing rounds. So therefore, a ROFR gives you the privilege of first choosing to take the offer before it goes to the rest of the market. And if the issuer went to the market without first offering you a deal, or even if they meet with you and then revise their deal, they need to then come and notify you again of the new opportunity. That's how the ROFR works.
All right, so a ROFR in your scenario protects the investor from the issuer going to market with a discount on their first offer to you, and also gives you the right to see any investment opportunity from the issuer first, kind of like a priority card.
Exactly right. And you can see how that can be both a protection and also an advantage.
Absolutely. If your investment gets hot and successful, you can be the first to double down before the rest of the market. And with tokenization, you actually essentially can resell almost immediately and take advantage of your premium access. But then you also need to assess whether the deal is a good one, because the issuer, of course, will be trying to outprice you, but not outprice the market.
Yeah, that's also true. And it can also be strategic in simply preventing dilution for an investor. And a ROFR can be chopped up also by allocation size and by the type of stock and other traits.
All right, so let's not get too complex in that regard, but what other ROFR examples can you see in a security token context?
Well, since we kind of know the basics now, instead of getting complex, let's get advanced. A ROFR can also be put in place for M&A purposes. That stands for mergers and acquisitions. So M&A ROFRs are usually for when you want a right to block or participate in the sale or merger of a company. So this may be purchased or previously made in a prior financing deal by a strategic investor or a corporate investor, but this allows another company to essentially make a play or be the first to buy before anyone else does, again being strategic and a business competitive advantage.
All right, so pretty much you'd see this when a company wants to buy the rights to buy another company before the competition has access to that deal.
Yep, that's exactly how it works. So let's get down to the real fun, right? How would ROFRs work in the context of tokenization? Because before, all of these are just legal documents.
So I can tell that you've been thinking about this far deeper than I have. So the floor is yours. What else do you have for us?
All right. So let's get to our more common example, right? So investors buying a security token that comes with a ROFR. Let's do a very simple example in that regard. Say we've purchased a security token that comes with a ROFR to buy any and all future issued security tokens first from that issuer. So how does it work when the issuer actually comes out with new tokens? Well, the security token you first purchased becomes an access token to prove ownership of that ROFR, and then you can begin the transaction. So the issuer likely put together a website where you can do this to move forward, or it's hosted in one of the technology providers. From there, an atomic swap can be initiated to allow the immediate purchase of whatever tokens are available in the counterparty wallet that can only be traded, using a wallet that holds the original ROFR tokens that you purchased, essentially creating programmatic, guarantee that ROFR is allowing you to purchase those tokens.
That's a really cool and use case. And like you said, you can program it different traits. So like the number of tokens that you can buy from the wallet, setting an allocation amount for the ROFR token, and then you could issue more ROFR tokens to more people with separate allocations. Or match the number of tokens so that if the token is worth $1 when I bought it, that entitles me to $1 worth of those the ROFR allocations, which means that if I invested 1 million, then I'd have the right to buy 1 million future tokens.
You nailed it exactly right, man. And that's where tokenization and smart contracts allow you to do all sorts of crazy new things. Think about doing this on a programmatic level. As an investor or a fund manager or whatever, I could set up my instruction to programmatically purchase tokens at a certain price as they are issued, allowing me to automatically purchase assets without needing to get involved in one single step other than setting the criteria. And I was able to do it all thanks to my ROFR right. Now that's programmatic asset management right there, Kyle.
So that's amazing. And because these have value that will build into secondary market value, similar to preferred stock versus common stock. So it's really interesting to think about how those models work. And I can really see ROFRs actually becoming a thing, Herwig. How about that M&A example?
Right. So with the M&A example, it is less about the market of investors and it's more about the two counterparties, right? So why would a company want to buy a ROFR to purchase a company with tokenization over the traditional way? So it's the same reason, of course. Programmatically being able to buy other companies is useful. I can think of this becoming very common in real estate or simply securitizing the ROFR so it can be sold to somebody else or having an immutable record of ownership to that ROFR. And of course, I'm sure there are many other benefits.
So that makes sense to me, Herwig. I mean, it seems like adding a ROFR to a security token isn't necessarily going to be commonplace in the industry, but it represents just another post-issuance service that issuers can provide to investors programmatically, meaning that it's both automatic and also a scalable solution that doesn't require crazy paperwork or documentation like we'd see in the traditional world. It's a niche but incredibly relevant and exciting addition to the tools of tokenization and really shows the benefits that a security token can provide to the financial sector.
Yeah, it's the little things, And on that note, that is all the time we have for you on the show today. So I hope everyone enjoyed and learned something. Of course, we are happy to answer any questions and feedback on anything we discussed on Twitter or LinkedIn. And better yet, you can join us online at stomarket.com/news, where you can actually submit articles, add comments, or even ask questions to the community.
Meanwhile, we hope to catch you next week on Tuesday for episode number 66. Thanks again for listening.